That's good whiskey. No, it's Diet Coke, actually. Don't get the wrong idea. It's now 1:30, and I'm getting ready for our 2:30 class where we're going to go over chapter 4. And I'm not sure how many participants we'll have on this holiday weekend. So I'm just going to wait a minute and then go into the material and get all of you prepared. Let me bring this up. All right, I guess I'll get started and hopefully we get a few people anyway showing up for the live class. If not, this is your class to be set up in Canvas this afternoon. Chapter 4, we're getting into something a little trickier called adjusting journal entries. Adjusting journal entries. At the end of the month, you run a trial balance. And so far in this class, we took that trial balance and we went with it. We prepared a trial balance and we went directly into our financial statements. What we're going to learn here is that by definition, when a trial balance is prepared at the very end of the month, it's not complete. It's wrong. There are adjusting journal entries that must be made to bring the trial balance up to date. These are internal kind of entries. They don't involve another company or another entity, just within us here. It'll be adjusting the prepaid expenses to their proper level. It'll be accruing wages and other expenses, depreciation expense, and maybe some unearned revenue. So let's see what we have here. Management is responsible for preparing the financial statements. That sounds like a very logical thing, and you might say to yourself, why do you even tell us that? Well, that wasn't the case until the last 20 years or so, when the Enron fiasco came out, the worst corporate scandal in American history. Management used to be able to put their hands in the air and say, hey, I'm just management. I don't know anything about the numbers. And they try to blame it on the accounting people. Now management must sign off on the 10K and on the annual report that they have reviewed and understand the financial statements. And you want those statements to be of high quality, obviously, useful to everybody, investors, creditors, employees, the government. The accounting cycle, in chapters 2 and 3, we analyzed transactions. Chipotle was doing things, and we recorded journal entries, and we then posted those journal entries to the general ledger. And at that point, we were ready to prepare our trial balance. Now what we're going to do is prepare a trial balance like normal to determine if the debits equal credits. But then what we're going to learn in this chapter is we have to prepare what are called adjusting journal entries, adjust revenues, expenses, and related balance sheet accounts as recorded in the general and posted to the ledger. And then we can prepare a complete set of financial statements. And then we're going to go into something called closing revenues. So this is kind of a busy chapter, and we'll probably go through it a little more before your test in some detail. Uh-oh, this thing doesn't want to. Oh, there we go. Let me fix this again. Got to get that out of my way. I figure if I'm having trouble seeing it, you might have as well. So I need to. Okay, make it bigger. The unadjusted trial balance. It's what we've been doing since the day one of the class. It's a listing of all the individual accounts, usually in financial statement order. No, always in financial statement order. Ending debit or credit balances are listed in 2 columns, and they should equal. That's all the trial balance does for us. It is not a published report of any kind. Nobody wants to see a company's trial balance. Doesn't really do anything. Now we've got 4 kinds of adjustments. We're going to go through these in pretty good detail. We have what are called deferred revenues and deferred expenses. Deferred revenues, deferred expenses. What's deferred is the service. The service is deferred. Deferred revenue, previously recorded liabilities that were created when cash was received in advance, and that must be reduced for the amount of revenue actually earned during the period. This is called unearned revenue. We are an insurance company. Somebody bought an insurance policy from us last week, June 28th. We got a check in the mail for $12,000 to pay for an insurance policy that covers the next 12 months starting in July. When we received that money, of course, we debited cash and we credited a liability account called unearned revenue. We don't owe this customer money, we owe them insurance coverage. So we're going to take that $12,000 policy and we're going to divide it by 12 to get to $1,000 a month. And every month we're going to debit the unearned liability account to reduce it. And we're going to credit income, revenue, okay, insurance revenue, deferred revenue. A deferred expense is the same exact thing as the deferred revenue, except we're on the buying side. Deferred expenses, previously recorded assets, such as prepaid rent, supplies, etc., that were created when cash was paid in advance and must be reduced for the amount of expense actually incurred. So let's put ourselves on the opposite side of the $12,000 insurance transaction. We paid for the policy in June, but the policy does not go into effect until July. So in July, we are going to debit insurance expense and credit the asset, the prepaid account. And we're going to do that every month for 12 months until the asset account, prepaid insurance, is down to 0 and we've recorded 12 months of expenses. The deferred revenue and the deferred expenses are the same exact transaction, depending on what side you are on. And then we have accrued revenues, revenues that have not yet been earned, that have been earned. That's the whole point. They've been earned, but not yet recorded because cash is coming later. What we're talking about here pretty much is interest income. We're in a position where we can loan somebody $100,000 at 12% a year. They're willing to pay us 12% a year. Well, that means that every month we have to accrue $1,000 of interest income, even though we're not going to get paid until early the following year. So maybe it's a 5-year note. So every month we are accruing $1,000. We are going to debit interest receivable, something like that, and credit interest income. We loaned money at 12% for 5 years. So starting, that's 12%, that's 12% per year. Well, let's call it $12,000. $1,000 a month is recorded income. Accrued expenses. This is the most common one. This is where you might have your most activity. Accrued expenses. Expenses that have been incurred but not recorded because the cash is going to be paid later. The classic on this is wages, salaries, and wages. You worked from the 25th of the month to the 31st. And during that week, you earned $1,000, just to pick a number. You earned that money in the month of June. So that money has to be on the June financial statements of your company. But you're not going to get paid maybe for another 2 weeks, depending on what the pay cycle is. So even though you're not going to get paid for 2 more weeks, the company has to record that as an expense in June. And they're going to do that with a debit to salaries and wages expense and a credit to an account called accrued salaries and wages payable. And we'll go into this in some detail now. Adjusting entry. How does the accounting system record entry expenses when one transaction is needed to record a cash receipt or payment, and another is needed to record revenue when it is earned or an expense when it is incurred? Boy, that's a mouthful. The solution to the problem created by such differences in timing is to record adjusting entries. Remember, revenues are recorded when they're earned according to the revenue realization principle, and expenses are recorded when they are incurred to generate revenue. The matching principle. What does the matching principle match? Revenues and expenses. Please know that. Assets are reported at amounts that equal the future benefits. Just want to see something here. Okay. So what are we going to do here? We are going to say, in analyzing adjustments, was revenue earned or an expense incurred? And most of your adjusting entries are a search for unrecorded expenses. So most of the time you could be debiting an expense. Did we incur an expense? Did we earn revenue? If the answer is yes, we got to credit the revenue account or debit the expense account in an adjusting entry. Ask, was the related cash received or paid in the past, or will it be paid in the future? If cash was received in the past, a deferred revenue liability account was recorded in the past. That's your unearned revenue. If cash will be received in the future, increase the receivables account accordingly. If cash was paid in the past, that's a prepaid item. This grid here is kind of wordy, and I'm not sure that it's worth really studying this too terribly much. Let's get into some real life examples, okay? Here is a real good look at your 4 types of entries. There's a 5th one for depreciation. That's pretty easy. But let's look at this. Let's look at the revenue to accrue an expense, okay? Accrued expenses, that's the one in the lower quarter of this grid here. Accrued expense. If cash was paid and previously recorded. This is if cash will be paid, okay? So what are we talking about? The month end comes and you look at your trial balance and you don't see any expense for electricity. You don't see any expense for the telephone bill. You don't see any expense for the gas, utilities. Well, you know you incurred those expenses. You incurred them. You have to record them even though you haven't paid them yet, and even though you don't even have the bill yet. You're not going to wait 25 days until you get the exact electric bill before you prepare financial statements. That'd be crazy. So what you have to do is estimate the electric bill, estimate maybe the phone bill, estimate the gas bill. In Southern California, on the Central Coast here, it's pretty easy. The weather's not that harsh from month to month. So our electric bill the last 3 months has been running around 1,000, then it went to 1,100, then it went down to 980. It was a little warmer. We'll accrue 1,100 this month. As long as the estimate you make is done on what accounting principle calls a systematic and rational basis, those estimated numbers are acceptable. Yes, there are estimated numbers on financial statements. What if we had an accrued revenue? Let's go to the other side, do the opposite. Here, we loaned money to somebody, and the deal is they pay us interest every year for the next 3 years. And that interest is going to be paid in January for the prior year. So what we need to do is record an adjusting journal entry where we debit interest receivable or some kind of receivable and credit revenue. Okay. We're not going to get paid that money until the end of the year, but we have to accrue it month to month. So those are your two accruals. Accrued revenues, accrued expenses means no money has changed hands. Accrued expenses, accrued revenues, no cash involved. You are recognizing the incurring of a revenue or an expense. Let's look at the deferred revenues and deferred expenses. Let's start with the deferred expense. What was deferred? The service or product is deferred, meaning it's going to be delivered later. So if you bought an insurance policy at the end of June for $12,000, you are going to debit an asset account called prepaid insurance expense, prepaid insurance. You're going to debit it from my famous $12,000. But every month for the next 12 months, you're going to write the same journal entry. You're going to debit insurance expense and credit the prepaid insurance account. And you can have all kinds of prepaids. You'd have prepaid rent, prepaid taxes, prepaid supplies, as you're going to have in your book all the time. Okay. So we bought an insurance policy. We record via an adjusting journal entry $1,000 in expenses every month. The company who sold us the policy, they record $1,000 worth of revenue every month. To them, it's revenue. To us, it's an expense. So understand, a deferred revenue and a deferred expense are the same transaction. It's just that one is being done by the person who bought the insurance and the other is made by the person who sold the insurance. What's deferred is the service. A deferred revenue, deferred expense means money changed hands, but nobody's done anything yet to earn it. And what they're doing here is they're just popping in another pair of accounts, property and equipment, fixed asset, in other words, accumulated depreciation. Let's take a look at this because this is your fifth. This is your fifth, number 5. Give me 5 so I know you're alive. The fifth journal entry. What we're saying here is we have property and equipment that cost us $1,217,000. That's what it cost. We are never going to change that $1,217,000 unless we sold the asset. So that $1,217,000 is going to remain the same every month. But we are allowed to record what's called depreciation expense. Depreciation expense. And we're going to take that depreciation expense and debit it every period. And we're going to credit accumulated depreciation. Accumulated depreciation is a contra asset account. It's contra to property and equipment. Since we never can credit the property and equipment, we credit the contra account, accumulated depreciation, which is married to the property and equipment, and we're going to record what's called the net book value. So if you would take a peek here, the cost of this asset was $1,217,000. Thus far, we have depreciated $370,000, which means that the net book value, and that's what you call that, they're calling it property and equipment net, that's okay. Net book value is $847,100. And we're going to keep making these adjusting entries every month until this asset is fully depreciated. Okay. And here's another look at our different types of adjusting entries. And again, we can go over it again in a little more clarity, hopefully. Remember, the deferred revenue and the deferred expense is the same exact transaction. It just depends if you're the one selling the insurance or buying the insurance. If you're the one using the supplies or selling the supplies, okay? Deferred revenues. Deferred revenue, that's the unearned revenue. Someone paid us in advance. We're going to do the work later. Deferred expense, you purchased an insurance policy. That becomes an expense every month after that. And then you have the accruals. You accrue expenses that you've incurred, meaning they happened, you experienced them, you got the benefit of them. Like the electric bill in your factory. Well, you had electricity because the machines ran all the time and there was light. You have to come up with that number. And accrued revenues, that's the interest that you will receive in the future, but you're recognizing the income each month as it goes up. So let's take a look here at a couple of entries and see if we can make this a little bit easier for everybody. Was revenue earned and not yet recorded? Well, they're telling us that the answer here is yes. When customers redeemed their gift cards, Chipotle provided food service. Remember, Chipotle sold $1 million worth of gift certificates, gift cards. And when they did that, they debited cash to increase cash, and they credited the liability account, unearned revenue, to increase the unearned revenue, to increase that liability. Now, $21,300 worth of gift cards were redeemed. Now it's revenue. So now we're going to debit that liability account, the $21,300, and we're going to credit sales revenue. So Chipotle no longer owes $21,300 in unearned revenue. They've earned this $21,300. So the question is, was the related cash received in the past, or will it be received in the future? The unearned revenue account was created when cash was received in the past, okay? The amount of the revenue that was earned is $21,300. There was a $33,400 balance in the unearned revenue account, is what they're saying, and now $21,300 has been earned. So here's a good representation of it, a very good representation. Compute the amount of revenue earned. Well, we know $21,300 worth of gift certificates were presented. We debit unearned revenue and we credit restaurant sales revenue or gift card revenue or food sales revenue, whatever they might want to call it. Okay? Unearned revenue. How about accrued revenue? Accrued revenue. Investments owned by Chipotle earned $200 in additional income for the quarter. Investments owned by Chipotle earned $200 in the additional investment income for the quarter. Cash has not been received yet. Was revenue earned? Absolutely. Is it recorded yet? The answer is no. It has not been recorded yet. So we need to record this interest income. We're going to debit interest receivable, $200, and credit investment income for $200. All right. Was the related cash received in the past or received in the future? That would be yes. And compute the amount of revenue. So look at your journal entry. It's a debit to interest receivable and a credit to investment income. All right. So that's two of our journal entries thus far. One of your adjusting journal entries, you're going to debit unearned revenue and you're going to credit regular revenue, sales revenue. And your other journal entry we've learned so far is you're going to debit interest receivable and credit investment income or interest income. Deferred expenses. Here is our prepaid. Here, it looks like we're looking at prepaid supplies, huh? Prepaid supplies. Let's see what they're doing here. Supplies include food, beverage, paper products. At the end of the period, Chipotle went out there and counted $10,000 in supplies. But holy cow, the asset account, prepaid supplies, had a balance of $216,600. Guess what? That means that they used all of the $206,600 except the $10,000. They used $206,600 worth of supplies, and they're down to 10,000 at the end of the month. Hope they know what they're doing. It seems like a disconnect. But anyway, they counted 10,000. There was a balance of 216 in the asset. So here's our adjusting journal entry. We debit the expense called prepaid expenses, and we credit the asset account called supplies. We would have debited supplies expense, credit the asset supplies, okay? And here's what they're talking about here. The easiest way to determine the dollar amount of supplies is to add the dollar amount available plus any purchases. So let's take a look. At the beginning of the year, they had $8,900 worth of supplies. During the year, they purchased another 2,077, which means that they have a total available of 216,600. That's the most they could have used, 216,600. You can't use more than you had at the beginning plus what you purchased. So they had 216,600. That number has to be in your ending inventory of supplies, or you used it. Well, at the end of the period, they went out and counted, and there was only $10,000 worth of straws and, chips and things like that. That makes the entry a $206,600 entry. Let's look at your prepaid expenses. Let's look at your prepaid again, okay? Here we have 36,000 paid in advance for rent. We have 32,000 for insurance for 1 year, 20,000 for advertising. A portion of the rent and all of the advertising has been used. Since rent, insurance, and advertising are categorized as occupancy expenses, we're going to use that as the title of the expense. We're going to call it occupancy expense. In the real world, you would break it out. You'd have prepaid, you'd have rent expense, insurance expense, and advertising expense. So they're giving us the number here of how much was used, $46,000, okay? $46,000. We debit the prepaid expense. I'm sorry, I said that incorrectly. We credit the prepaid expense. We credit the asset. We debit the expense, rent expense, or insurance expense, or advertising, whatever it might be, okay? The prepaid expenses. And here they're just showing it to you in terms of the accounting equation. And now they're showing you how they came up with the number. The rent, now they're telling us after they showed us the number. They had rent 3 months, 6 months prepaid. So half of that is 18,000. Here we have 32,000 prepaid. That would come out to 8. Advertising was all used. So take a look at your general ledger. There's your general ledger. We debit the expense, we debit the expense and credit the prepaid account. We debit insurance expense, we credit prepaid insurance, okay? Now here's your 5th journal entry. This is the one you pray will be on the test because it's the easiest. depreciation expense. The reason I say it's the easiest is because it's always the same two accounts. It's always going to be a fixed asset, and it's always going to be depreciation expense and a credit to accumulated depreciation. It will always be a debit to depreciation expense and a credit to accumulated depreciation. Here's a big truck, a big fixed asset. We purchased this truck for $200,000, and we are allowed to depreciate it over a period of years. There are some guidelines from GAAP principles from the AICPA, and we're going to record the wear and tear on this truck every month. So let's see what we're talking about. To keep track of the asset's historical cost, the amount that has been used is not subtracted from the asset account. It's accumulated in a contra account called accumulated depreciation, okay? So whatever we paid for that truck, that's going to stay the same. So here we go. The company used buildings and equipment during the first quarter. No expense has been recorded. So expenses, of course, are understated. So they give us the number for depreciation expense. You debit depreciation expense and you credit the accumulated depreciation account. So what's gone down is not the original cost of the asset, but the net book value. The net book value. Take a peek here. You debit depreciation expense, 20,100, credit accumulated depreciation for the same amount. You now have a balance in the accumulated depreciation of 390,100. We will subtract that from the original cost of the truck to come up with the net book value. Accrued expenses. Numerous expenses are incurred in the current month without being paid for. Well, your salaries, of course, and your utilities are the best examples. And we went over a couple of those just earlier. Salaries and wages. All of you in this class, you work at Chipotle, and together you work the last week of the month, or the last 2 days, in this case, and you earned $13,400. That is a June expense to Chipotle because you earned this money on June 29 and June 30. You're not going to get paid for maybe 2 weeks if you're on a biweekly cycle, but the money was earned in the month of June. So in the month of June, we have to record salaries and wages expense and credit accrued wages payable. They're calling it accrued expenses payable. That's okay. Accrued salaries and wages payable. We recognize that this money that you earned on the last 2 days of the month belong in that month, not the following month. And here's a peek at it. Take a look at your expense. There was already a balance of $138,600 in that account. That represented the payroll for from the first of the month through the 28th. That's payroll, that 138.6, that we've processed and paid to the employees. Now we're layering on those last 2 days with a debit to salaries and wages expense and a credit to accrued salaries and wages payable. Interest on debt. Chipotle owed $233,200 in notes payable. Another accrual. The average rate is 7.7%. Notes payable was recorded properly when the money was borrowed. Its balance is not going to be adjusted. However, the interest expenses occurred by Chipotle over time. 7.7%. If you guys need a loan from me, I'll charge you 7.7% and very happily do so. So they computed the interest expense. They're not showing you how they came up with the number, but they came up with $4,500, $4,500 for the period. Let's see here. 223 times 7%. That's what 7 times 3 is 1, here, 2. That's about 14,000 a year. Yeah, it's about 14,000 a year, or 4,500 per quarter. The point is, what's the journal entry, not what the exact number is. You debit interest expense and you credit accrued salaries and wages payable. Okay? Accrued, not salaries and wages in this case here. It's interest expense. It would be interest payable. Here, we're accruing an expense for money that we borrowed, okay? And here they're doing the math I tried to do in my head just now. Came up 4,500 per quarter. And remember this very important note. Unless told otherwise, the interest rate on loans and borrowings is always an annual percentage. Always an annual percentage. So in this case here, the annual rate was 7.7, but that's per year. And we're only doing 1 quarter's worth of activity. So we take 3 months and divide it by 12, 1/4 of a year to get the 4,500. Don't make that mistake on a test. Easy mistake to make. And we'll take another look at the general ledger. We're going to debit interest expense and credit accrued interest payable. That's exactly right. We're going to do the same thing with the utilities. They got an electric bill, $4,000. The bill's going to be paid next month. You debit the electric bill, electricity expense, credit accrued expenses payable. You're not going to get that exact bill for another month. And here you look at your utilities, okay? The final adjusting entry is record income taxes. Well, company has a profit, they're going to have to pay maybe 30% income tax. This requires computing adjusted pre-tax income, the balance in the revenue expense accounts from the unadjusted trial balance, plus the impact of all the other adjustments. In other words, what they're saying is, whatever your net income is, you're going to have to pay additional taxes on top of that. So let's see what we have here. Their revenues and gains. And this is kind of interesting. Before we did any adjusting entries, we took out our trial balance and the revenues and gains were 624 and the expenses and losses were 247.8. So we had a certain amount of profit. And now look at our journal entries. We accrued some interest. We accrued some other kind of interest. We had the 21.3 was unearned revenue. So we pick up the unearned revenue. We have interest to accrue. And then we had these various accounts here. We had the prepaid expenses. We had the depreciation and all that. So our change now is the gains, the income, sales revenue. Let's call it revenue. The revenues were 645.5. The expenses were 542.8. 102,700 pre-tax profit. Wow, look at the tax rate, 38.9%. Wow. So 102,700 times 38.9% equals $40,000. Nice, they made it come out so even, huh? Our net income before tax, 102.7 multiplied by the tax rate of 38.9% gives us this journal entry here. And there it is on your general ledger. Okay. So that's a pretty good look at adjusting journal entries. They're a little tricky until you get the feel of them. I think you can see that most of them are a debit to an expense. We're either recording an expense or a revenue, okay? And every adjusting entry has an asset, not an asset. Every adjusting journal entry has a liability, asset, or capital in it. A better way, what I'm trying to say is every adjusting journal entry has a balance sheet item and an income statement item. You can't have two from the balance sheet or two from the income statement. That's the nature of the adjusting entries. A question of ethics. Ethics. These statistics I reported, I can tell you a lot of war stories about financial fraud. We'll go into that perhaps later. Hold on here. I got the happy fingers again and ended up bouncing back. Okay, income taxes. Here's where we're going. Preparing the financial statements. We have now come up with the correct trial balance. So we're going to prepare the financial statements. And we always start with the income statement because we need to get the net income in order to update the statement of equity through retained earnings. So net income moves from the income statement to the retained earnings portion of equity. And then when we get the final equity number, we bring that over to the balance sheet. And you had plenty of practice doing that in the past 2 chapters. So here is our trial balance after we did the adjustments. Notice we now have interest receivable here. We didn't have that before. These are all the accounts that we used in preparing our adjusting journal entries. Interest receivable, accrued expenses, everything there. Is the rest of the balance of the trial balance. All the dark orange, that is representing the accounts we just used. We had interest receivable for $200. We should see interest income for 200. Oh, it's in the 4,900. They had interest income before that. Take another peek here. Supplies, 10,000. And then you're going to have the expense on the occupancy, 60,400. So there is our adjusted trial balance. And again, everything, you draw a line under retained earnings. Everything above that line is your balance sheet. Everything below it is your income statement. So let's take a look at their income statement. I see sales of 640,600. And here it is right here. Sales, 640,000. That's really 641 million in dollars, minus all of your operating expenses. That gives us income from operation. That's the good quality income. And then we have the below the line items type things, investment income and interest expense. That's all about financing, gain or sale on the fixed asset. Subtract that out and we get the income before taxes times 38% or whatever that number was, gives us net income of 62,700. Earnings per share, $1.73. $1.73 earnings per share. And we'll talk about that. Earnings per share, you've probably heard that metric before. You will note that the EPS ratio is reported on the income statement. It is widely used in evaluating the operating performance and profitability of a company. And the calculation is net income divided by the outstanding shares. Typically, you average out the beginning and ending shares of stock and then use that to divide into net income. In this case, it came out to $1.73. Notice how they got the average shares. There were 31 million shares outstanding at the beginning of the year, and at the end there were 41 million. So it looks to me like they issued another 10 million during the year. Okay, that's what they're saying right here. Income, 62,700,000 divided by 36,217,000 shares outstanding, $1.73. If you own stock in Chipotle, you might say to yourself, well, that's $1.73. They might be able to return to me in the form of a dividend. The final total from the income statement is carried forward to retained earnings. Carried forward to retained earnings. There is our net income of 62,700. And here it is being brought over to the equity statement. And notice your equity statement has three categories now. Common stock, which is simply the outstanding shares times the par value. It has no market meaning. Additional paid in capital, whatever cash we generated above the issue of the common stock at par, and then your retained earnings. Your retained earnings are zero when a business begins. If they had a profit after the first year of $10,000, then retained earnings would be $10,000. If they had another $14,000 the next month, it would be up to $24,000. Retained earnings is where your net income is moved or retained from the income statement. If a company gives out dividends, that comes out of retained earnings, okay? And here's our balance sheet. And notice what we did. We brought over every single number. We brought over every single number from the trial balance except one. And that one is your total stockholders' equity number. Take a peek here. That's the new number. Your trial balance had the old numbers. The trial balance had 300 shares. Yeah, see, December 31st, 11 compared to March 31st. Quarterly statements. Take a peek at your equity section. They had 300 shares outstanding, and then they issued another 100 here. That's the par value of the stock they issued, 10 cents per share. Additional paid in capital, okay, that went up, and so did retained earnings. And if anybody wants to follow the detail of it, here it is right here in your equity statement. The 434, 731, 1166. 434, 731, 1166. Focus on cash flows. As presented in the previous chapter, the statement of cash flows explains the difference between the beginning and ending cash balances. The cash flow statement is a categorized list of transactions that affect cash. Three categories: operating, investing, and financing. Since no adjustments made in this chapter affected cash, the cash flow statement activities categories identified on the T account at the end of the month remain the same. Many standard financial analysis texts warn analysts, trying to get that word out, warn analysts to look for unusual deferrals and accruals when they attempt to predict future periods and earnings. They often suggest that wide disparities between net income and cash flow from operations, that's a useful warning sign. In other words, you can have a company that's showing tremendous cash flow, or let me say it the opposite way. They're showing big profits, but lousy cash flow. That's a real warning sign. Tesla might be an example right now, although I hope the future is bright for that company. Tesla right now is showing good net income without the best cash flow. They're not selling many cars, but what they are doing is they're selling carbon credits. They're selling carbon credits because they're a clean energy environment. They're allowed to sell what are called carbon credits to companies who pollute more than they do. And that's how they're making their money. But that's not what they're in business to do. That's a side job. Their business is to sell cars. So they're showing pretty good profits from these sales of carbon, but they're not making any money selling cars yet, which has to be their future. cash flows. There's not going to be anything on the test, really. Cash flows, you would have disclosures on the cash interest paid, the cash income tax. Disclosure means that the company has a note and they're giving you some information that they're required to provide. And that's what we're talking about here. Disclosures, a schedule of significant non-cash investing and financing transactions. Here we go. Later in the week, I'm going to give out your FSA assignment. I'm deciding between Coke and Pepsi or Kentucky Fried Chicken and Popeyes or something. And I'll give you the two companies. And you're going to have to do a lot of these metrics. So let's take a look at asset turnover. You know, this will be on the test, okay? Asset turnover. Asset turnover. It's your net sales divided by the total assets. Net sales divided by the total average assets. So they come up, they divide out this number by 2 to get the average. So the sales were 2,269,500 divided by the average assets gives them a turnover of 1.782. 1.782. Let me suggest something. If you go into a meeting with your boss and you tell and you say to him or her, hey, the asset turnover was 1.782, he or she might look at you like you speak. What do you mean the average? What do you mean turnover? And then you would say, oh, well, it's the number of times that we turned over the average assets. Again, you're going to get a blank look and the flop sweat's going to start flowing. What I'm suggesting you do is turn this into days. How many days in a year? 365. You divide 365 by 1.782, and you get the number of days. In this case, that would be 365 divided by 2. It would be about 190 days, roughly. That your boss would understand. We turn over the assets every 192 days. Let's go over closing journal entries, and that'll finish this chapter. This is a busy chapter, huh? But fortunately, we're a chapter ahead in our scheduling, which means we have plenty of time to review. And for those of you not quite keeping up all the way, time to get the help you need. Okay, either through tutoring with me or whatever resources you might be able to commit. Closing entries. Well, closing entries. We're going to transfer net income to retained earnings. How about that? We're going to take net income and remove it to retained earnings. Well, we know that. That's why we did the income statement first. So even though the balance sheet accounts balances carry forward from period to period, the income statement does not. Anything on the balance sheet is called a permanent account. You never close it. At the end of the month, you have $1 million in cash. That's it. You're done. You have $50,000 in accounts payable. You have $200,000 in equity. Those numbers are going to stay forever. You're never going to zero them out. The numbers are going to be changed every month and just keep it up. Temporary accounts get closed. Temporary accounts are anything on your income statement, okay? So let's take a look at what we're talking about closing. At the end of the month, you will have a zero balance in all of your sales and expense accounts. They'll all be restated to zero because you move that profit over to retained earnings. And here's an example here. Here is one example. I hope they give us a better example. But they're showing us part of this entry. We have sales revenue of 100. We want to close it out. We are going to debit sales revenue to make it zero. We have this gain on a fixed asset. It has a credit balance, so we debit it to get them down to zero balances. We have wages expense and we have loss on sale of assets. Those are both debit balances We credit them and we credit the loss on the assets, okay? So that's what we bring over here into retained earnings. We had a beginning balance of 6,000 and now we have 80. That's the 130 in credits minus the $40.50 in debits that we reversed. In other words, we're moving the net income into retained earnings. I'm going to go over this again with you at another time using a little bit of better presentation on the closing entries. But essentially, here's what we're doing. Close your income items first. Close your income, your revenues first. You do that with a debit to the accounts, and then you can credit retained earnings. Then close all of your expenses like this, all of the expenses, and that would get debited to retained earnings. The net is 62,700. You remember that number? That was our after-tax income. Once we're done with that, the only thing we need to do is prepare what's called a post-closing trial balance, which they're not nice enough to give us. They're not even going to give us a picture of it. But it's a trial balance where you're going to see assets, liabilities, and equity and nothing else, okay? And that's it for this chapter. Very busy chapter, but I think an interesting one. All businesses do adjusting journal entries. They're the nature of the beast. You can't avoid them. They can be very significant depending on the business. If you have a capital intense business with a lot of machinery, that's a lot of depreciation expense. You want to make sure that you record. And, we'll go from there. I hope you guys all had a good holiday. I had a very nice one. Thank you. Saw some friends for the first time in quite a while. And let me thank you for hanging in with this long lesson. And I motion that the meeting has come to an end, okay? Talk to you later, guys. Bye-bye.